Welcome to the Oral Wealth Prosperity and Practice Podcast, where we provide detailed strategies for dentists and healthcare professionals to live their best life. Today, we are recording the next episode on the practice series, which is getting deeper into advanced retirement strategies. Specifically, on the last episode, I talked about 401ks and defined pension plans. So we're going to go deeper into those and how you can really use that to accelerate tax savings and retirement savings. This is mainly for practice owners and other successful professionals looking for more ways to save on a pre-tax basis and reduce their tax bill. The big topic we're going to talk about today is the defined benefit plan. It's a great way to front load your retirement savings. It's also known as a cash balance pension plan. So for the beginning, what is a defined benefit plan? A defined benefit plan is a type of pension where instead of a defined contribution plan or there's two different types of pensions, a defined contribution and a defined benefit. The defined benefit plan is what you typically see in large corporations where the benefit is defined in your employment records. A defined contribution plan, which is a cash balance pension plan, allows you to contribute a certain amount up to IRS limits. In the pension plan, it still grows like a pension. And over time, you can use that money for retirement. So when we talk about different types of plan, we usually look at that defined contribution. So unlike a 401k, it allows for that contribution, but with way more limits. So when you're looking at this structure, and I talked about this a little bit on the previous episode, but you start with the 401k, you get your $23,500, you get the catch up if you're over 50. Then you add on a profit sharing, which starts, getting a little bit more complicated. You have to bring in what they call is a third party administrator. And that third party administrator says, okay, if you want to contribute up to $70,000 for yourself. So like you did the $23,500 and a match. And now, you want to max that out, right? To $70,000. You will have to contribute some to employees. So ideally you're an older doctor with younger employees. That'll allow you to get majority of that benefit in the profit sharing, which is what a profit sharing is for. The owner should get a majority of that. Once you're like, oh, well, I can actually do more than 70 is when you add in what we're going to discuss today, which is a defined contribution plan. That also requires a third-party administrator, also requires you to match or allow certain employees to contribute to it. So it's an additional benefit to the employees, but most of the benefit should go to the owner. We're talking about 80 to 90% of the contribution goes to the owner, allows them to reduce his taxable income and save significantly in retirement. So this plan is twofold. Hey, these are my highest earning years. I don't want to pay a lot of taxes. And two, I might have not saved as well as I should have in retirement. Let's juice that up. And it has a great benefit. So the good thing is you don't have to choose between these plans. Like typically it's 401k, then you choose whether you want to do a profit sharing, then you choose if you want to add a cash balance pension plan. There's more administrative costs to these, but that's way outweighed by the tax savings. So who are these plans right for? So I have a couple examples that I can talk about. So I have some dentists that are in their 40s, 50s, and have younger staff, and they've begun to earn a significant income. So whatever income that is for you, this could be in the 500 to a million range of income I usually see. And their income is growing faster than their lifestyle. So they have a lot of taxes and they have the cash flow to contribute. They set up a cash balance pension plan, pick a number that they're comfortable contributing every year, and they do the 401k full contribution. They do the profit sharing to the full amount. Then they tack on that cash balance pension plan. These plans usually have to stay open for 3 years. I've seen some be able to close earlier, but typically these are designed to stay open for a while and provide that benefit. There's a lot of factors that go into how much you can contribute, ages of staff, also investment performance, or the amount of the contribution. They have a limit to how much you can put in here over the lifetime. So all these variables play, and that's why the administration is more. The other type of client I've seen to use these plans is somebody who is selling a practice, a piece of real estate, or have multiple practices and they're selling maybe one practice. So in the year you sell, you have your high income from your work as a dentist, but you also have the income earned from the practice sale. And this is where absolutely getting a CPA involved is important, because a lot of times when you sell real estate or a practice, it's on capital gains and not earned income, which the cash balance pension plan is made to offset. But if you reposition some of that income or use the excess cash flow from those sales to make a large contribution, I've seen cash balance pension plans be front loaded in the $200,000, $400,000 range, using that excess cash flow to offset ordinary income. So think about your tax savings. Let's say if you're in the highest tax bracket at 50% and you contribute $200,000 to this plan, that's $100,000 in tax savings. So it's not insignificant. And again, it might be expensive working with, a financial planner and your CPA, but if they brought a strategy that saved you, $10,000, $20,000, $30,000 in taxes, it's paid for itself, over and over again. And again, you use these strategies not once, but over the years, it can really be a big benefit. So again, how do you find this is right for you? If you have excess income, if you haven't saved well enough for retirement, if you're just looking to not pay the government as minimal taxes as you want, talk to somebody, talk to your CPA, talk to your financial planner, make sure just test whether this would be right for you. They can run an illustration to see what that contribution might look like. You can decide whether it's something you want to do. There's a lot more detail that goes into this, but again, I'd just lose all of you guys if I start going into all the details. So if you want to look into this, reach out to your professional. If you have more questions, reach out to me. Again, by combining the profit sharing and the defined contribution plan to your 401k could create massive, tax savings, enhanced retirement savings. So on that note, thank you guys for listening to the Oral Wealth, Prosperity, and Practice podcast. Don't forget to click the follow button to be notified when new episodes become available. Make sure you share it with your friends, family, and colleagues. and look forward to seeing you on the next episode. You can also visit my website, www.navapathfinancial.com. All this information is in the show notes. So I'll see you next time.